Investing can be scary. We give our money to companies and expect them to turn a profit. Beginners may have negative thoughts about what could happen to their money, leading to improper decisions resulting in losses, and sometimes large losses if problems aren't not resolved. There are many ways to make money in the market, but it is crucial to be confident and consistent with your investments. In this portfolio, I seek to provide consistent and predictable returns. I will consistently deposit money and buy profitable companies that will generate cash flow that we can then reinvest as we like. Without a solid vision of what someone's portfolio will look like in years to come, they too could be susceptible to some of these mistakes. The first reason is investors don't have a strategy. Buying securities at random is usually not the best option. News and media promote risky investments and may lead investors away from their current strategy. Some accredited strategies include growth, swing trading, and value investing, and that is where I choose to focus my time and money. Some people may judge and critique the way you invest, but it is very crucial that you choose one strategy and stick to that strategy. There are many resources such as Google Finance, Yahoo Finance, MarketBeat, Seeking Alpha, Morningstar, BNN, CNBC, and this can be overwhelming for investors. It's very easy for investors to change their strategy when they see a company move 50 or 60% in a day. This makes it hard for an investor to distinguish good companies from not so good ones. The second reason is investors don't really know what they're buying. Like I said, there are a variety of investments to choose from, and it can be hard to know which one fits into your portfolio. Some securities, like options and futures, can be difficult to understand, leaving the investor in the unknown for what to expect in the near future. Other investors may stay away from options and futures, but buy companies they know nothing about. I believe it is important to know exactly what the company does and how they make money. As an investor, you need to know how you're going to profit. This reason is linked to the first one. Some investors may do this because they do not have a strategy to begin with. The third and final reason is not knowing their own risk tolerance or being greedy. If an investor doesn't know how volatile a particular company or industry is, they might waver from their strategy, selling early and changing their strategy on the spot. Being diversified across industries lowers volatility and allows for more calculated risks to be taken. Sometimes it can be more profitable to be invested into only a few companies, but I believe it is easier to see trends in the whole market rather than a few particular companies. If we look at an example from earlier, we see that this investor started off making some profitable trades, but as they started to make money, they started to enter riskier and riskier positions, resulting in losses later on. This investor, we can see, consistently contributes money and at the same time records profits. They have a clear trajectory of where their portfolio is headed, and by sticking to their strategy, they can maintain profits and returns over the long term. In this portfolio, I adopt a similar strategy. By depositing money frequently, I am able to buy securities frequently, developing cash flow that I can then reinvest into positions I own or reach out to other companies in the market. It is important for an investor to have a strategy, know what they are buying, and know risks without being greedy. By doing these three things, an investor is setting themselves up for success over time. If you like this content and want to follow along with this portfolio, like and subscribe and watch this portfolio grow over time.